Hello everybody and welcome to lecture number 17 of the Ethan Trades mentorship. So I'm going to be doing some episodes like this for now just to kind of get it out and show you guys the idea behind everything. It won't be as high quality as the ones with the slides, but as those, develop, I'll post those and replace these ones. So these kind of lectures are going to be temporary lectures. So in this lecture, I wanted to introduce liquidity. So introduction to liquidity. And liquidity is quite a simple concept. It's something that you will be using on a day-to-day basis, just like Unit 2A, Unit 2B. You will be using liquidity as one of the fundamentals. And that's how you're going to end up reading order flow. And so order flow, paying attention to market structure, you've learned that. You want to pay attention to footprints or PD arrays or areas of interest, you just learned that. And now introducing you to liquidity. So liquidity is essentially the fuel for the markets. So without liquidity, price cannot move, nor can anyone place a trade. Something to understand about the markets before you can learn what liquidity is that trading is a zero-sum game. This means that when you make money from the markets, someone else loses the difference that you made. Vice versa, when you lose money to the markets, someone else made the difference that you lost to the markets. And so that money that is transferred from one trader to another trader is what we call liquidity. And, that's why sometimes when you see, for example, Jason and I bantering, we'll be like, oh, you're my liquidity. Because let's say he's in a long, I'm in a short, which means he's buying an asset and I'm selling an asset. Well, whenever we call each other liquidity, it's the transferal of that difference. So if he loses money, that means I make money. If I make money, that means he loses money, right? So that's a little joke that traders like to say. And so with this understanding now, smart money is in a constant battle of taking liquidity from uninformed money, or dumb money, if you want to call them that. As a retail trader, we are fending for ourselves, as we are not only protecting ourselves from smart money, but we are also protecting ourselves from other retail traders as well. And so this is why we sit in a gray area where we are not smart money nor uninformed money, because we follow smart money's footprints in the market, all while trying to avoid being uninformed money. So we're kind of in this gray area where we're not necessarily smart money, but we are looking for clues that smart money leaves behind. So large players in the market, whenever we see displacement, for example, we'll be like, oh, it looks like there's a large player. And so we're trying to avoid being uninformed money where we're just constantly losing money, but we're also not really at that point of smart money because we're not the ones moving the market. And so as a reminder, just as you've all learned the fundamentals, in Unit 2, liquidity is not to be used on its own, but in confluence of everything, because market maker models are made up of all three fundamentals blended together. So that would be your market structure, order flow, and liquidity. And now we can finally create those market maker models and create that narrative because we're learning about all three things. And so we can visualize liquidity on a chart by understanding there are orders. So that would be buy orders or sell orders resting above every high and every low in the market. And so this is often the case because of how majority of traders view the market. And because of that, they will place their stop losses above or below swing points. And so now I'm going to explain how trading futures works. So I've come up with a little analogy for you guys, so it's a little easier to digest. When you're trading, what you're doing is expecting to buy or sell an asset at a future price to profit off market price movement. And so longs are the terminology for when you buy an asset and expect the asset to appreciate in price, thus profiting the difference. And so, for example, longing is basically buying a phone at $1,000, expecting it to be worth, let's say, $1,100 within the upcoming weeks. And then selling it 1 week later, you would profit $100, or whenever price reaches $1,100. And then if you sell it, then you made $100. Pretty straightforward. So on the flip side, if price went down instead, you could always hold the phone that you bought itself until price goes higher, or hold it until it's worth absolutely nothing. And you would end up taking a $1,000 loss if it went to $0 value. And so that comes in the importance of a stop loss. So what a stop loss does is a point in price where you determine to just call it a day and take the loss pretty much. So instead of holding the phone to $0, you may want to only endure a $200 loss. And so you determine that when the phone is worth $800 in the market, then you're just going to sell it and take the loss of $200. And that's pretty much how it works. On the flip side, shorts are a little trickier, but it's pretty much the same concept. So on the flip side, shorts are when you sell an asset and expect the asset to depreciate in price, thus profiting the difference. So you may ask, how can you make money selling an asset and the price goes down? Well, back to the phone analogy as used in the long example, imagine you think that a specific phone will go down in price within the next coming weeks. And so what you decide to do is capitalize on this price movement by borrowing your friend's phone. Let's say you have a friend, and in this case, your friend would be the broker that you're trading with. But let's say it's a friend instead. In this analogy, you borrow your friend's phone, expecting the price to go lower, and so you sell it now to a willing buyer. So let's say I sold the phone for $1,000. So now I'm holding $1,000 in cash. Well, later down the road, when price goes lower in the market, so the market price of that phone goes lower, let's say it goes to $800. Well, when that phone is worth $800, you buy back the phone for $800, and now you still have $200 cash, and that's going to be your profit, right? And you give that phone back to your friend, for example. And so that's how shorting works. And so once again, in trading, that friend you're borrowing assets from would be the broker you trade with. So wherever you put your money in account to trade, that's your broker, also known as a liquidity provider, because they allow you to buy or sell whenever you please to. And so that's why it's very important to have liquidity providers in the market, because they can manipulate the market. However, they're also taking on all the risk and allowing us to place orders whenever we please. And so just to list a couple examples of brokers, this would include Interactive Brokers, Thinkorswim, Trade-Evate, Rhythmic, NinjaTrader, and there's many more. So resuming the analogy, on the flip side, if you sold your friend's phone at, let's say, $1,000, keeping it, consistent, and then some weeks later, the phone is now worth $1,100. And so you could always hold the phone itself until price goes lower, or you can hold it until it's worth all that you can afford to lose. And so once again, that comes the importance of a stop loss. So instead of holding the phone to $2,000, where you'll have $0 left, because now you're taking a $1,000 loss, you may want to only endure a $200 loss, for example. And so you determine that when your phone is worth $1,200, you're just going to buy it back and take the loss of $200, give it back to your friend, or in this case, the broker. So that's all for this lecture. And I know it's a very quick introduction to what liquidity is. I promise this will all make sense. In the next lecture, I'm going to be teaching you guys support and resistance and how to spot liquidity on a chart and why liquidity is so important. So see you in the next one. And as always, have a great day.